My name is Hoda Mehr. I am founder and CEO of StockCard, and today we want to talk about Twilio, ticker TWLO. So many of you have voted for Twilio to be the focus of today's episode, but also I understand why you're asking for it. The stock was once being traded at around $300 per share for its 52-week high, and now it's being traded at $46 per share. And specifically, latest earnings result, which came out on November 3rd or somewhere at the early November, resulted into a significant drop in the stock price. So the question is whether the stock market and the price drop, and specifically algorithms who have started selling the shares of Twilio, are right about the company, or there's something that is missing in their calculations and we have an opportunity to buy this stock at a great price. Even more importantly for all of us, is Twilio going to be the next 100-bagger stock or not? So as usual, let's bring up the company's stock card and get started with our 7-part framework. Twilio, as of today, it's being traded at $46, and the company's market cap, it's around $8 billion in market cap. So if we multiply that by 100 in order to evaluate its market cap at 100 times return, it's something above $800 billion in market cap. So that would be the 100x return. One way that we recently came to test the possibility of a company becoming 100x is to look at its competitors and see whether their market cap is as high as what Twilio is right now. And in case of Twilio, I thought Cisco system could be a good comparison. Cisco system is also in the communication and messaging market, cloud communication and messaging market, and their market cap, or this company's market cap, is about almost $200 billion. And so if Twilio can become as big as the incumbent in the industry, which is Cisco, it can become a $200 billion market cap, but we're still not going to get 100 times return for Twilio. It doesn't mean that Twilio cannot get there. It's just that we always have to adjust our expectation for when we think about a company giving us 100 times return, whether there is a possibility or a logical feasibility for that market cap to happen. But forget about Cisco, because Cisco is the older generation of companies in communication services. Let's look at what the market potential is for the company and whether there is total addressable market in the industry, in the markets that Twilio operates in, and figure out whether there is enough market potential in terms of addressable market capitalization for Twilio to grow into an 800 billion plus company. So if we go to the growth potential segment of Twilio's stock card and look at the markets that the company operates in, it obviously operates in technology and communication services. The one that we want to pay attention to is this cloud communication platform that's expected to grow about 27% per year between 2020 and 2027. So if you go to this source, which basically gives us the cloud communication platform market size and forecast, it basically tells us that in 2019, the cloud communication platform market was almost a $3 billion market, and in 2027 it's expected to become almost an $18 billion market. So let's use this as our base and evaluate whether Twilio, operating in that cloud communication market, can get into that total market cap of 800 billion, or what kind of market cap is possible for Twilio if it operates just in that global cloud communication platform market. So the market size of 17.6 billion. Let's assume that the overall market gets a price to sales ratio of 10, which is extremely expensive, but it's a rapidly growing market, so a price to sales ratio of 10 could be possible. That gives us a market cap potential for the entire cloud communication market of around $170 billion. If Twilio gets a 10% of that market in terms of market share, it can become a $17 billion company. So currently it's being traded at a little bit more than 8 billion. And if it can grow as fast as the market and gets 10% of that market cap potential, it can become, it's almost a double return for Twilio. If it can get 50% market share in that market, it can become a $85 billion company, which is a 10x return for Twilio. So that's the current market. That's the cloud communication market that Twilio operates in. But let's stretch it a little bit further, because when I listened to the latest earnings call with the management, with Twilio's management on November 3rd, I learned a few interesting things. So Twilio started its company as a company that provides the infrastructure required for other companies to send messages to their customers in an efficient way. So by messages, let's say if you're taking an Uber and then you would receive a SMS message, a text message that says your Uber driver is close to you, or a DoorDash driver bringing your food, and you receive that your DoorDash driver is close to you, those messages can be handled in a very effective way and can be built on top of Twilio's infrastructure in a very cost-effective way. So that's where Twilio started its products and services, and that's where it was growing very rapidly. And it's the cloud communication market that we just talked about. It messaging is growing all around the world, and all companies want to communicate with their customers, deliver services to them, or send marketing messages to them, and that's why they need Twilio. But recently Twilio realized it's not just about messages and customer services. It's actually a lot bigger than that. Brands want to have direct relationship with their customers, and they want to be able to send personalized, customized promotions, messages, and communications to their customers. And that means that Twilio now has a bigger market opportunity. Twilio now can become what they call it internally as customer engagement platform. Not only they can allow technically for you as a brand to send a message to your customers, they can also allow you to make that message relevant and personalized and send it at the right time to your customer. So Twilio is suddenly expanding its total addressable market size and the total addressable market capitalization by extending its operations and its products and services into this customer engagement market opportunity. And that's why they've recently acquired a few companies. Segment is one of the companies that they've acquired, and they launched a product broadly just recently called Twilio Engage. Engage is basically for engaging customers. So that basically results into a much higher total addressable market. So according to Twilio's latest earnings presentation, their total addressable market is expected to grow by 13% per year, and is expected to grow to $116 billion in total addressable market by 2025. So let's assume Twilio is correct and they understand their total addressable market better than you and I. With a $116 billion market cap, if we assume a price to sales ratio of 10x, that would result into a market cap potential of 1.16, almost $1.2 trillion. And if Twilio gets 10% of that market cap, that becomes a $116 billion company. So from an $8 billion company right now to $116 billion company. It's not quite a 100x return yet, but it is much better than what we assumed before. And it's very easy to understand why Twilio is trying to expand its total addressable market and why the growth potential for this company can be significantly higher based on what markets they're entering in and what the growth potential is ahead of them. All right, let's now go back to Twilio's stock card and do the research together to figure out the company's growth rate in terms of revenue, earnings power, and free cash flow. So as usual, we want to go to the company's financial strengths. Financial strength section of any stock card is where we pull all the financial information that you would need in order to evaluate a company's financial strengths in a very easy and digestible way. First up is revenue. Based on 6 different analysis, the company has a strong growing revenue, and basically let's take a look on a quarter-over-quarter basis. It's grown about 4%, and on an annual revenue basis, last annual year versus this annual year, Twilio has grown by 61% per year. And if we look at the 3-year compounded annual growth rate, the company has grown by 58%. So Twilio is certainly growing rapidly, but if we even annualize its latest quarterly earnings, which is 4, and multiply that by 4, the growth rate is slowing down. And that could be one of the reasons the algorithms were not very happy about Twilio, and after its latest earnings result, they decided to sell the stock. So growth rate is good and solid, but it's not as strong as what it was at once. So we need to monitor that and see why the growth rate is declining. And next up in our analysis is profitability. It sounds like Twilio has some problems with profitability based on 22 different analysis. The company is struggling with profitability. The company is not profitable, and we can actually go and take a look at things like net profit. Looks like it's negative both on a quarterly basis and on an annual basis, and it hasn't really been improving that much as well in the last few quarters. So profitability is a concern, but companies could be profitable but generate free cash flow. Let's figure out whether Twilio is one such company. So I'm going to scroll down to the free cash flow section. Unfortunately, it looks like Twilio is also not generating free cash flow. It's based on 5 different analysis. The company is struggling with generating any free cash flow, meaning that its business model still consumes significant amount of capital expenditure, and also they haven't yet found a business model that results into profitable operation. They still need to use significant amount of external capital in order to grow their business. So they better have tons of cash on their balance sheet in order to be able to fund their operations, because this company is still in growth stage. And I want to make sure the company has enough cash on its balance sheet in order to be able to grow. And this fact that it's unprofitable and doesn't generate any free cash flow, it's not going to be an issue. So if I go to the cash on that section, this gives me some peace of mind. The company has almost $5 billion in cash. So yes, it doesn't generate any free cash flow or not profitable, but at least it has enough cash on its balance sheet that it could we could be comfortable that the company can continue its operation without raising external capital, and basically that gives the company a few years of runway in order to become profitable or become cash flow positive. So if we basically go to our framework, let's recap. It needs at least $800 billion in market cap. And it is good to see that it's expanded its market cap, addressable market cap, by getting into the customer engagement market. So there is an opportunity to grow its market cap much bigger than what it is today. It's still not going to be 100x based on the evidences we saw. Solid year-over-year and quarterly growth rate. But we've seen some slowdown, not generating any profits and not generating any free cash flow, but at least it has about $5 billion in market cap. We have 3 more criteria to evaluate in order to understand Twilio better and figure out whether it can become the next 100-bagger or not. So let's basically jump into those analysis. But before we get into that analysis, I want to share very good news about a stock card. A stock card is a finalist in Benzinga's FinTech Award 2022 in the best investment technology category. I'm very excited about this nomination, and hopefully we're going to win this competition and become the best investment technology in 2022. But I wanted to share this good news. If you're not a stock card user and this is your first time watching our 100 Bagger series, I highly recommend you go to stockcard.io and sign up for StockCard. It's free to sign up, and you'll understand the power of our platform and our technology and why Benzinga has nominated us as a finalist in Best Technology Platform. Now back to Twilio. So the three next things that we need to evaluate for Twilio's 100 Bagger analysis is whether the company's valuation is at a range that is favorable and we should basically buy some stock because we get it at a good valuation, the quality of leadership team, and the moat or competitive moat of the company as it stands today. So from a valuation analysis, sounds like based on 10 different analysis, Twilio is fairly priced, which is good to see. Of course, it's not profitable, so price to earnings ratio, it's not something that we can rely on. Scroll down to price to sales ratio, and it sounds like Twilio is being trading at 2.3x, 2.3 times its sales. And it's at least half of its peers, its competitors, or companies with a similar market and market size are trading at almost 5 times price to sales ratio. So it is being traded lower than its peers. And although 2.3, it's not as cheap as the average of the market. I believe the S&P 500 is being traded as around 2x its price to sales ratio. But compare it to some other technology companies. Last week, for example, when we look at PubMatic, or when we look at even a Meta platform, or when we looked at companies like Unity software, Unity is being traded somewhere around 13 times this price to sales ratio. So when you compare it to other technology companies, the 2.3 times price to sales ratio is quite favorable for Twilio. So based on price to sales ratio, the company is being traded at a quite favorable price to sales ratio or valuation. And I didn't show this on our analysis on the stock card, but the company's price to book value is also less than 1 time, which is extremely crazy for a technology company that is growing at 60% per year. Even with the latest earnings result that they shared with us, they're forecasting the company to grow about 18 and 19% per year, year over year. And this 18 to 19% year over year, it's also all organic. It's not all driven by their acquisition. So when you think about a company with this kind of growth rate in terms of revenue, and when you go back to the price to book value of less than 1, there's something quite interesting here in terms of valuation. The next 2 criteria that we want to discuss is the company's quality of leadership team, whether they have skin in the game and the right executive team in place. And the second one is about the company's competitive mode. So the most important thing when it comes to the leadership team is to see whether the leadership of the company has the skin in the game, has enough ownership of the company's outstanding shares in order to make sure their incentives are aligned with incentives of shareholders, that us. And in case of Twilio, first of all, the CEO is one of the co-founders, original co-founders of the company, and he has 3.6, almost 4% of the company's shares and 21% voting power. So this is one of those situations that we get. The company CEO and co-founder is still with the company and also has the significant voting power in shares, ownership in the company. And the other thing we need to pay attention to is that when I listened to the latest quarterly earnings report, I realized the company has recently had gone through sort of a restructuring of its sales organization, has brought in former Google employees or former chief revenue officers from other technology companies to its leadership team to sort of form a new chapter in the company's future. So those are good signs. Of course, always when a company goes through leadership team, there will be some time in order for that leadership team to really operate at their highest capacity. But it sounds like Jeff, who is the co-founder and the CEO of the company, have been able to hire the right people for the next chapter growth rate of the company's future. So I give it a thumbs up when it comes to the leadership quality. And when it comes to moat, there's a few things we need to pay attention to. One is that Twilio has a strong brand, always been known as a company in technology sector that is always focused on developers. They always used to call themselves developer first, meaning that they focus on simplifying the life of developers. And in technology, that goes a long way. It means that a lot of the developers, those people who are in the everyday work, would ask and recommend this platform to their decision makers, the managers, and basically they become advocates for the company within the customer organizations. That's one thing. The other thing that I really like about Twilio's mode is that it's getting expanded by the company expansion into customer engagement market. It gives the company what's known as optionality, and optionality is a good thing, meaning that if one thing fails in your organization when it comes to basically generating revenue from one source, you still have these other products and services that can still bring cash and revenue for a company. So expanding its total addressable market into the customer engagement is a good thing from a mode point of view because it creates optionality. And in case of Twilio specifically, they always follow this, what is known as land and grab strategy in tech, meaning that they first bring you in with some sort of a introductory product, and once you're hooked in, they start upselling new products and services to you. And we can see that in the company's above 100% retention rate, revenue retention rate, and Twilio has above 100% net retention rate in its revenue, and that's another good sign. The only thing about Twilio when it comes to its mode that we need to pay attention to, it's its gross margin. Gross margin, as we've talked about in the previous 100 Bagger series, it's an indication of how cost effective is for the company to deliver its products and services to its customer. And one of the reasons when you read the news out there that investors are not happy about Twilio and maybe algorithms are selling the Twilio's stock is that its gross margin has been declining from above 50% to less than 50% in the last few quarters. And I was very worried about that because that could mean that the company doesn't have the strong competitive mode as we want to see. But I was very happy to hear about a company's explanation for that decline in gross margin in its latest quarter earnings. Basically, there's two reasons behind it. One is that you remember how we said Twilio has this infrastructure that allows companies to send messages, text messages to their customers. For Twilio to be able to do that, they need to work with, let's say, Verizon and AT&T and other carriers like that. And recently in the United States, these carriers have increased their fees that they charge to companies like Twilio and their customers. And Twilio basically takes this fee and pass it to its customer because it's technically just a pass-through fee from the carrier to their customers, whoever brand that is using Twilio. But the results into mathematically or from an accounting point of view increases cost of goods sold, which is what you need in order to calculate your gross margin. So that's one thing that they explained it very well. The second thing they said, generally speaking, the company is rapidly growing more than 30% in international market, and international markets are quite expensive when it comes to carrier fees, much more expensive than the United States. And when the company is growing rapidly in international markets, it increases its gross margin. So those are the reasons that the algorithms most likely don't pay attention to, but there are logical reasons that we can understand why the gross margin is declining. So all in all, if you want to recap it, there are some really good strong signs for Twilio to become a next 100 bagger. But of course, from a size point of view and from an earnings and free cash flow point of view, the company is struggling. So before we wrap up, I want to remind you of a Stockcard's crowdfunding campaign. Stockcard is building a 100-bagger company in the consumer investment tech industry. You and I as retail investors can use the Stockcard platform to make higher returns and make better investment decisions, among many other use cases for Stockcard. So if you really want to be part of our 100-bagger story, head to republic.com/Stockcard. Check out about our roadmap and our goals for the future of company, and we hope you become an investor in the company. That's again republic.com/Stockcard. So let's wrap up. If I want to monitor Twilio in the next few quarters, what would I pay attention to? One is I really want to make sure the company's expansion into the customer engagement the solution pans out as they planned. Obviously, it's a really, really good plan because it expands their total addressable market and it's a higher margin opportunity, but also it's something that their customers have been asking for based on what we've heard from the management in the latest quarterly earnings. But this plan needs to pan out. Simply, they need to be able to execute against it. So that's one thing I would monitor and pay attention to. And then the other one is can the company become profitable? They've talked about it extensively in their quarterly earnings. It's a focus area for them. They do want to become profitable and at least generate free cash flow, or at least generate profitability in non-GAAP ways. So that's another thing I will be monitoring. As I said, I don't think this company become a 100x return for us just because of the total addressable market and where it is in size and the challenges it has currently with its profitability and free cash flow. But I truly believe this is an opportunity to buy a very good company at a really good valuation and sort of monitor those two things that we said we're going to monitor and maybe gradually add to our holdings. I do own shares of Twilio, both independently and indirectly through my ownership in ARKK, ARK Invest flagship ETF. So I am closely watching this company. As always, if you enjoyed this episode and you found it informative, I invite you to like and subscribe to our channel. That's how YouTube algorithm works. If you like it and share it and subscribe, YouTube assumes that we have good content and we can spread the word of intelligent investing to more retail investors out there. Thank you very much for watching, and I'll see you in the next episode.